This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So today we welcome Mark Hebner, who is one of the pioneers in the space of evidence-based advisors, and he founded, back in 1999, Index Fund Advisors, Inc. IFA.TV is a website. And man, his website was literally one of the first ones on the internet to start to explain evidence-based investing and indexing and the power of indexing. And he built this site, which I discovered back in just after he opened 99-2000, as we were migrating from active strategies over to passive and fee-based. And everyone's heard that story before. And wow, he is still at it. And it's an incredible collection of the data, and he talks about this in the interview. So he was very instrumental early on in our development in this space. So it was really fun to have him on to talk about where he's come over the past 20 years and how he explains these concepts to investors.
Yeah, his ability to communicate and to use images to communicate, which is I think what he's focused a lot on, is impressive. The story that he tells at the beginning of our conversation about how he got into this is also really interesting. I won't retell it, but his transition from being a high net worth investor who was being, fleeced, if you want to call it that, by a stockbroker, to discovering indexing and then eventually starting his firm that he has now. It's a great story.
Yeah, so he's the author of the book called Index Funds, the 12-Step Recovery Program for Active Investors. And it's actually available for free on his website in digital format at ifa.com/books. We'll put a link in the show notes. He has an MBA from UC Irvine and a bachelor's in nuclear pharmacy from University of New Mexico. And he talks at the end about his career before founding IFA. So we reached him at his home in Newport Beach, California. And,
sorry.
Go ahead.
His website, ifa.com, the charts that he talks a couple of times throughout the conversation about charts. So obviously if you're listening, you can't see the charts, but his website, ifa.com, has a section that's just loaded with charts illustrating basically every concept that allows you to arrive at the idea that index investing makes sense. So as a cross-reference, if you're listening, you can check out his website, ifa.com. If you're watching, he was sharing his screen so you can see the charts.
Anything else to add?
No, I think ifa.com for any do-it-yourself investor is a fantastic resource, right up there with any of the other great resources that people know about in terms of having tools and calculators and charts, and yeah, it's a good resource.
Agreed. So with that, here's our conversation with Mark Hebner. Mark, it is so great to welcome you to the Rational Reminder Podcast.
My pleasure to be here.
Well, I must say the pleasure is ours, and for me it's pretty special because I've been following your material for over 20 years now. So you were the pioneer in my mind of bringing information to the public, and Ben and I are doing our part now with the podcast and with Ben's YouTube channel. So it is a real privilege to have you here.
Well, thank you so much.
So when I saw you present at a conference, it's got to be 10 years ago, you told a story of your personal experience of how you came to set up Index Fund Advisors. Can you share that story?
Sure, be happy to. Well, it kind of started off with the fact that I was the CEO of a publicly traded firm, and I had the opportunity to basically sell out of that firm at a ripe old age of 32.
Wow.
Which might be close to one of you guys, I'm not sure. Anyway, it was a while ago for me. And I ended up with this big chunk of money, and I was cold called by a Morgan Stanley broker who monitored those kinds of sales through public companies. And he informed me he was Steve Jobs' stockbroker. He was up in San Francisco, and told me all these wonderful things they were going to do for me. And so I thought, okay, well, I'll give him this big chunk of money that I just received from the sale of the company. And 12, 15 years go by, and one of my friends was killed in a car wreck. And it took a few years, but the widow finally called me and asked if I would help her with her investments because she knew I was a business person. Well, as many of us know now, just because you know something about business doesn't mean you know jack about stock market, how stock markets work. And when she asked me to do this, I felt this tremendous obligation to help her, but I also knew that I didn't know much about this and had basically been listening to my broker for all these years tell me which stocks to be in. We went through gold and oil, and he bought a bunch of muni bonds. And so anyway, that got me digging into the information a little bit. And I went to the local Barnes & Noble here in Newport Beach and picked up 20 books or so. I think it was 22 books. Walked out of there and I had Random Walk. I had all the Bogle books. I had a bunch of other indexing related books by Scott Simon and a bunch of other folks. Sorry, I turned this off. And so I started plowing through those. And interestingly enough, one of the first things that hit me is, gee, why didn't I read about this before? And I used to call myself, I was like a thoroughbred waiting at the gate because I was 32 and I was the CEO of this publicly traded firm. And really all I cared about was finding another company to run. But I didn't realize my real job was learning about this big pot of money that I just earned. So after going through all those books, it's now 1997, 98 probably. And the internet's out there and you could start going out and comparing, your portfolio to the S&P and to, look at all these charts and graphs that you could create. And that was probably my first foray into the whole idea of using charts and graphs to educate somebody else because they provided such an education to me. But the bottom line is after I did my investigation, I figured my opportunity cost, now this is not a lost amount of money, it's the amount of money I would have had I understood this, when I got my money in 1985, was in the vicinity of $30 million. So that was quite a rude awakening. And I remember I wrote a 20-page letter to this stockbroker because we became kind of buddies. I think like a lot of people end up being with their stockbroker, where he was calling me almost daily, about this or that, because I was kind of a whale for him, and it was an opportunity for him to generate a lot of commissions. And so I started digging into all this. I went to the widow. I explained to her what I found out. And then I said, I've been thinking that maybe there's an opportunity to use the internet to tell this story to the world because I don't see anybody out there doing it. It was indexfunds.com, had a little discussion board and there was a little information there, but these were people just talking to each other. And the business of indexfunds.com was to sell banner ads, what they were doing in the old days. And that basically failed. I ended up buying indexfunds.com from those guys. But anyway, that was the primary source. William Bernstein, Jeff Troutner, a lot of this same old guys that we talk about were, and that you talk about and talk to, were posting on indexfunds.com back then. But nobody was really making what I would call an advisory business out of this. Right. And so I said, so then someone showed me Flash, okay? Steve Jobs killed Flash, but Flash allowed us to do these incredibly dynamic charts where you could click and choose and move stuff around. And I thought, oh my God, that's what's missing here, is this ability to be able to rapidly change this information from one portfolio to the next, from one asset class to the next, and basically create a lesson right there in front of the client. In my original business plan in 2001, I think I wrote one up finally, included a Zoom-like presentation, what we're sitting here doing now. It was called Microsoft Net Meeting, if you recall. That was their video software. And my original vision was having advisors video conferencing with the clients. I wanted 100 advisors sitting on their computer screens, video conferencing. I didn't get there. I've got 12, but that was were my grand plans back then. So anyway, so the widow also had a pretty good chunk of money. And I told her, I said, listen, the last thing I want to be accused of is taking advantage of a widow, you know, one of the worst things you see brokers do. So I told her, you need to read this John Bogle book. I gave her one of Bogle's books. I can't remember which one. And she was traveling all the time. And she had a college education and she loved to read. So she says, I'm going to do it. So she took it on an airplane. And I said, I want you to write in the book, take notes. So I have evidence that you actually did this. She brought it back to me. She says, Mark, this is fabulous. You should start a business and I'm going to be your first client.
Wow.
So that was the beginning of IFA.
I gotta back up and ask a question. You wrote a 20-page letter. What was the conversation with the stockbroker like?
Well, it was basically explaining how the S&P did better than all his stock picks over this period of time. Also, how he had me in this heavy bond portfolio. I found out later there was a group of brokers at Morgan Stanley where this was their strategy. Get the client in, put them all in bonds, make them feel comfortable, and then slowly start trading more and more stocks. This is exactly what he put me through. I had somebody who interviewed with that group at a later date, and he told me about it. Anyway, I went through and I explained all this stuff, and 20 pages, it was probably the first version of my book, really, to put all that information down. And I just said, you know what, I'm leaving and I'm moving all my money to Vanguard. And that's what I did. Then I ran across some other books that started talking about dimensional and this, what do they call it, select group of advisors who have access there. And then I thought, man, that's an interesting business opportunity, and decided to set up the advisory business. And it's what I think of as really the first robo-advisor, because I had this whole online advisory business. And the only difference from what you see today is I didn't go to a Apex or RBC and create my own brokerage, white labeled brokerage business. Thank goodness, that's a real big headache. But also, I was just funding it myself. You look at Wealthfront, Betterment. What are these guys? What did they raise? $400 million or something?
Yeah, right.
$300 million or something. So, and that's kind of the other unique thing about what I did is because I made money in another industry. I had money, and so I didn't have to bring in all these partners. I didn't have to go raise capital, and so even today, I'm the sole owner of this company, and it makes it a lot easier to make choices. I only have to deal with me, myself, and I. But that myself and I, they're horrible.
All right. So you mentioned your 20-page letter was the first version of your book. Your book is called, for the listeners, it's called Index Funds, a 12-Step Recovery Program for Active Investors. Of the 12 steps, and maybe this speaks to what was most impactful to you when you went through your initial research, but of the 12 steps in your book, which one do you think is the most critical for people to grasp?
Well, I think step one really is the most critical. Step one kind of summarizes the whole book in little bits, and it lays what I call a really good solid foundation to then go on to the other steps. But quick little story about the 12 steps is one of the things I just couldn't believe when I finished all this reading is that so many people continue to be active investors. I thought, what the heck? And then it just hit me that maybe they're gambling. And then I Yahooed, there was no Google back then. I Yahooed gambling in the stock market. It took me to the New Jersey Alcoholics Anonymous website where there was a tab for stock market gamblers. And I said, aha, I'm going to use that. I was looking for some structure for a book. Because one of the things I didn't like about all the other books, and I probably read, you might have seen, I have a library of 2,500 financial books now. I didn't read them all, by the way, but I read many books. And I didn't like the way they kind of mixed stock picking throughout the book, that it didn't work, market timing throughout the book. And what I wanted to do is I wanted to have all that evidence in one place, in a step or in a chapter, so that if somebody had that particular issue, they wanted to time the market, I could take them there and it would all be there in one condensed place. And so I was looking for some structure, like Stephen Covey's, what is he, what's Stephen Covey's book? I can't remember.
7 Habits of Highly Effective People.
Yeah, right. And so when I saw the 12 steps, I thought, you know what, that's a perfect framework, because it also ties into this whole sort of gambling mentality that investors, I think, are involved in, but they don't realize it.
That's the key. They don't realize it.
Exactly.
So one of the first things in the book you define are the behaviors of an active investor. And in that, you included some definitions that most people probably don't consider. Can you talk us through the behaviors of an active investor?
So where was that? I think it's in step 1 here, early on. Yeah, here they are. So I can knock through some of them here. Owning actively managed mutual funds, that's an obvious one. That you're trying to pick a manager to beat the market. That's part of being an active investor. Picking individual stocks, picking times to be in the market, makes the market timing. Picking a fund manager based on some recent performance, a little bit like the first one, but there's this whole track record investing that goes on. I like to remind people you can't buy yesterday's returns. Picking the next hot investment style. Today, get into those large growth stocks or hyper large mega stocks, hyper large growth mega stocks. Disregarding high taxes, fees, and commissions. So this is not probably so obvious for everybody, but the active investor basically says, hey, listen, I'm going to double my money, or I'm going for a 10-bagger. What do I care about these fees, taxes, and commissions, right? And then also risk, same thing. They're willing to concentrate, their investments in a few things, taking on enormous risks, and they're just not, risk isn't really a concept for them. It's pre-Markowitz 52, right? They're only looking at returns.
Yeah.
Somehow the variance of returns hasn't recurred to them as to be a big deal. And then investing without a clear understanding of the value of long-term historical data. That ties back to my riskies chapter. And one of the really important conclusions that I've come to after 21 years now of doing this is that if people don't have some understanding of statistics, even a basic understanding, it's going to be really hard for them to be what I'll call a good passive investor or client of a passive advisor.
Yeah. And that is tricky because a lot of people don't have that background. And we have a...
You know what my test is? I says, if I flip a coin and get 10 heads, what's the probability of tails? That's my first test. If they say 50-50, I know, I've got a chance. But when they say, it's 80% tails now after all those heads. So gambler's fallacy there.
Yeah, and most people, like I mentioned, don't understand statistics, which makes it hard to stick with a strategy like this. I mean, you look at small cap value relative to large cap growth over the last 10 years. That's hard to stick with if you don't understand the data. In the book, you talk about the Ulysses Pact, which is a reference to the Odyssey, where Ulysses ties himself to the mast of the ship to avoid being sucked in by the song of the sirens. What do you think investors, and maybe particularly investors that don't understand statistics like we were just talking about, what do you think they can do to avoid that siren song of active management or high past returns?
Well, first of all, I think they need to get help, okay? They really need the advisor, right? I mean, we're the ones with the ropes here. We're going to tie you up. So, my subtitle on all my investing videos is Replacing Speculation with an Education. And it's really about getting a good quality education. And it's one of the reasons I wrote the book. But then I found I couldn't get a lot of people to read the book. So that's why I got together with Robin Powell and I did the film that was basically, just based off a script from the book. And it turns out that has been pretty successful because a lot more people will sit and watch, an hour video than try to plow through a book. It's not, it doesn't have all the information. It's not going to be as good as watching the film, but they'll get the general sense of what's going on from the film. But the education, I think, is the key. They really have to spend some time learning these concepts. And I also tell people you got to hear it 3 times at least. So the first time is when they're a prospect. Probably the second time is when they invest and the first market crash comes along. Then I kind of got to start over. And then the third time is when, kind of like we're seeing now, is when their portfolio is not outperforming the market, as they like to call it. So we just recently did a video about what is the market and what is the proper benchmark for your portfolio, trying to teach people it's a blended benchmark. You need a blended benchmark. I remember Sharp talked about this early on in some paper he did for some, finance society, is that you've got to put together a blended benchmark. One benchmark is rarely appropriate, certainly for a whole portfolio, but even for funds, that's basically what you're doing in your multi-factor regression.
Right.
So you mentioned large cap growth stocks earlier. So we're currently living, all of us as advisors, living through an era where the large cap stocks like Apple, Facebook, Amazon, Microsoft, Alphabet, Tesla are really dominating not only in returns, but I think a lot of conversations that people are having around the market. And I think a lot of people may be tempted to either go back or go to stock picking in that area or to heavier weighting towards large cap growth stocks. So what do you tell someone when they say they're thinking of doing that? They've had it with maybe their value portfolio, or they just want to go where the returns have been?
Well, so first thing is a good lesson in history. So let me just try to pull up a little chart here. This is basically the 10 years of data before I started my firm. If you look at the subtitle up here, this is January 1 of 1990 to December 31st of 1999. We did our first trade in November of 99. And this is what we were looking at. And here we see the S&P at 18%. Here's large growth for 10 years at about, 21%? And NASDAQ at 25% per year for 10 years. And so who wants to buy all of these sort of DFA diversifiers down here, if I'm a French factor-loaded type portfolio of international small value, which basically had 0 for 10 years, international value down here at 7. And so basically nobody wanted to buy this. And back then was a lot like what you're seeing now, if you think about it. In fact, let me go forward now to the 2000s. This is basically my first 10 years of doing this. And now you got the S&P at -1 for 10 years, the last decade. You've got large growth and NASDAQ all down here below, and they completely reversed from the 10 years prior, right? Mm-hmm. Well, wait another 10 years and you get something else. This is the last 10 years, the second decade of my doing this. And you can see it looks a lot like the first chart that I showed you 30 years ago, 3 decades ago, and it flipped again. And so the real lesson in these, and I did a recent video on looking at 5 decades, is that 10 years is not enough information from which to draw conclusions, which gets back to our point about understanding statistics. With all this volatility, even in asset class returns, forget about stock returns, but among asset class returns, you're probably best looking at least 5 decades of data to start to draw conclusions. And so to look at the whole 50 years of data, I've got here the 70s. And so here's now 50 years. And when you look at 50 years, you see that S&P, that large growth, that small growth, that NASDAQ, all again down towards the bottom. And these sort of DFA factor diversifiers of large value, small value, emerging markets, small and value. Now, these are, you have to dig into how we create these indexes, because that data doesn't go back to 1970, but you can look at that in our back-tested disclosures. Anyway, you can see that the value over the whole 50 years was there. Had you known this, of course, nobody did in the 1970s, and you couldn't even invest in these in the 1970s. But it just is a reminder that you see this flip-flopping of large growth and small value type of investments, even 10 years at a time. Does that answer your question? Now I can't remember exactly what you asked.
Well, it does, because it's very interesting. And the timing of when you founded Index Fund Advisors was exactly at the point where we come off the decade of the 10 great years of large cap growth. That's exactly when you opened. And then you had, I presume, the first decade. That's what I'd like to hear from you now. Like, what was it like in the business, and what was the client experience like for that first decade? And the clients that you've had since then, are they kind of saying, well, yeah, we've seen this movie before? Because it feels eerily similar in many ways today to the way it did back in 99, 2000.
Yeah. And also in 1720, by the way. the big growth stocks of 1720, the East and West Indies companies, the South Sea companies. And this is a story that's repeated over and over, over 300 years, where people basically think they're going to cheat risk. That's what I like to call this. They're going to get rich quick, and they're going to cheat risk by hopping into, some stock that's had some great return for some period of time. It was very difficult. In fact, as you asked that question, one thing that came to mind is I remember sitting actually in a lawyer's office after we were working on an angel deal with a gentleman who had basically run up, maybe he had $1 million. He ran it up to like $13 million in these .com era stocks, right? This is probably 1999. And I'm showing him all this Fama French data that says, that's a really bad idea that you're also tilted towards these stocks. Of course, he told me I was crazy. He said, that's all academic nonsense. He says, look at my portfolio, okay? Well, that portfolio dropped back down to about 750,000 from 13 million. And he was literally crying on the phone to me over his whole world, turned upside down. So listen, that's one anecdotal story, but these kind of things happen. People get incredibly rich. A few lucky people get incredibly rich, and then everybody wants to jump on that bandwagon, and the data just doesn't support it. One of my favorite things to do is when someone comes to me with the theory. You've got these ARC funds. What's this gal's name? Catherine Woods. When they come to me with these incredible stories, I said, can we just compare resumes to whoever's in charge of that strategy with Eugene Fama's resume, and let's just see, who you might want to accept their recommendations. Which one of these do you think is more valid? And we have an article on our website, Fama One of a Kind, where we literally list every Fama paper with a link to about 90% of them. And we go, okay, what do you got on the other side here? Just because they had a great return in 3 years or something?
Yeah, it's the power of the narrative, because when you're investing in something like ARC, you don't want to get a decent return. You want to get the far right tail of the distribution. You want to knock it out of the park, and you're not going to knock it out of the park doing what the data suggests you should do, because the data doesn't suggest you can knock it out of the park.
Of course, none of these people understand the distribution. This is the problem. Or do they accept the fact that all returns are kind of starting with the same expectation? Listen, Fama once told an advisor group at a DFA conference, He sees the primary job of advisors is to teach clients about the distribution of returns that they're in for, in essence, okay? And that's the great thing about something like this is that you have an expected return up here, but down here you have a realized return. And there's a very wide range of realized returns relative to that expected. And that is such a hard concept to get in people's heads. First of all, they don't accept randomness. They don't accept efficient markets, which sets a fair price, which positions these expected returns to be essentially constant over time. Everybody wants to argue with that, but I don't see anybody really profiting from. I saw your thing about Cliff Asness and how but even he says that's not a good idea to try to time these factors.
Yeah, he's written papers about it not being a good idea.
Yeah. So anyway, now I lost track of your question. We got off on.
I think we answered the last couple questions that you've been talking through were about picking stocks and what you would tell somebody if they were thinking about doing that right now, and you kind of addressed that with the
wait a minute. I do have one more important thing. Over the years, there's always another chart that I latch on to. Hang on a second. Yeah, over time, there's different charts I use to teach people about the dangers of stock picking. But this is my current favorite chart. So this is a study by Standard & Poor's, part of the SPIVA study, that looks at persistence of outperformance by actively managed mutual funds, right? And they break these out by asset class here. But because most people who are doing this, like the stocks you mentioned, Apple and Facebook, whatever, they're doing it among large cap stocks. So let's look at 938 large cap mutual fund managers over just 3 years. How many of them beat their benchmark? Only 99. So right off the bat, that's horrible odds. But what I really like about this study is they followed that 99 for the next 3 years and 0 continued to outperform.
Yep.
And so when these professionals, who I like to say get paid, $1 million to $5 million to do this, when they can't do it, what makes you think you can do this on your own, So to me, that's really strong, compelling evidence. And if you look down here, it's pretty much the same in a lot of these asset classes.
Yeah, we've talked about that data many times on the podcast in the past. So we have just sort of, maybe for now at least, come out on the other side of some pretty extreme market volatility, some historic market volatility. And I'm sure that there are lots of people out there, maybe some people listening to this podcast, maybe not though, because we have a biased sample of people who are maybe not trying to time the market. But anyway, there are probably people out there who are thinking about not getting into the market right now or waiting for a better time to invest. How do you articulate, and I know there's a chapter in the book about it, how do you articulate the folly in trying to find the perfect time to get into the market?
So I like to use a little diagram I came up with in 2008. Here, the market had crashed multiple times. Please make note, when I talk about markets, I always like to speak in the past tense. People, Gerard O'Reilly is now correcting a lot of the other people at Dimensional that they're using the wrong tense when referring to the market. A lot of people say the market's going up or going down. There is no such thing because the future is uncertain, right? Yep. So you can only talk in the past tense. But what I like to use is this little diagram that is my way of explaining the way markets work. And in essence, why do prices change? And so what I'm showing here is, let's just put this on a 60-40 portfolio. That's something more common for investors. If I was to look at a 60-40 portfolio, and this is one of the things we do at the company, is we create this historic data of these blends of indexes and funds when the funds became available. So you can get a characterization of a risk and return for various asset class mixes or whole portfolios. And if you look down here, for over 50 years, the way we hypothetically backtest this data, the monthly return for this portfolio has been 0.81%. Well, for me, that's a pretty good way to set your expected return going forward. If it's that way for 600 months, it's probably that way in the future, as long as prices are fair. And so what we like to say is we've got every day, every moment, new information coming along. And sometimes it's good news, sometimes it's bad news. And I think of the intersection of that as being the uncertainty of your expected return. So if I've got really bad news, my future returns look really uncertain. I got really good news, my future returns look really certain, right? So what's the job of a free market is to set prices so investors will be positioned to earn a fair return given the risk they have in their portfolio. So, in a inverse way, the price is set inversely proportional to the uncertainty of your expected return. And that price is set by, 10 million buyers and sellers every day around the world, roughly. And because of so many active participants in price setting and price discovery, really, we think that prices are fair all the time. And so the prices are changing so that the expected returns remain essentially constant. You might have seen in a recent little DFA video they put out, somebody said, who was it? It was Novi Marx. Novi Marx says, I get up every day with the same value premium expectations. Every day I have the same expectations. Well, how can that be when we see prices moving all over the place? Well, that's why the price is moving, is so that these expected returns stay essentially, I use the word essentially constant because I know everybody's got all their ways of talking about what expected returns are. And so to me, this is a reason not to try to time the market. If every day has the same or every month has the same expected return, what are you doing? What are you betting on? You're betting on an outcome that's, I have a little button here for the active investor. The active investor is forecasting what that future return is going to be. And they don't think that it starts in the same place all the time. It's going from -5 to +5 or even more than extreme than that. And they don't think prices are fair either. This is one of the reasons that people don't understand that statistics applies to the market, is they don't understand that a fair price actually allows a statistical analysis to be useful.
It also assumes that much of the information that person is making the decision on is not known by the market. Like, who doesn't know there's a U.S. election coming up soon? Who doesn't know that it's unknown when there'd be a solution to the pandemic? Who doesn't know these things? Therefore, that information theoretically must be priced into the market.
People read the internet as though they're the only ones reading it. Or they read the Wall Street Journal as though they're the only ones reading it, and they're going to glisten some information from there that they're going to be able to use to exploit, some other trader. So it's kind of silly. Are we preaching to the choir here?
Yeah, the choir likes the songs we're singing, though, I think.
I don't. It's like you said, you have to hear it 3 times. I think you have to hear it more than 3 times.
Yeah.
Exactly.
I don't think you can hear this stuff enough.
Yeah.
So you mentioned tax earlier. So many people are catching on to the benefit of index investing, but a lot of the dialogue is really focused on pre-tax underperformance of active management. How big a role do you think taxes should play in the decision to avoid active management?
Oh, it's huge. I mean, if most traders are recognizing short-term gains, they're not holding much longer than a year. And so they're all paying, I don't know about in Canada, but in the US, it's all ordinary income, which is, for a high net worth, high earner, you're talking, especially in California, it's almost half your return. So you thought 2 and 20 was bad in a hedge fund. Try paying 50% of your gains in taxes. It's what I call, in my silent partner chapter, the government is your silent partner. You don't even know they're there until it comes tax time. And I've yet to see an investor who really could even calculate their after-tax returns. Went to the trouble to go back after they filed their taxes and adjust all their returns accordingly. So actually, many of us at our firm often comment on the fact that few clients really even appreciate how much taxes they are saving, especially with the tax loss harvesting that we're doing in client accounts. That's enormously beneficial for those who are in a position to harvest those losses. So anyway, taxes are huge. It is one of the key reasons that you become a passive investor is so you're not recognizing these gains. We see this sometimes in clients. I remember there was a client the oil had gone, I don't know what, to $99 a barrel, and he was all freaked out. And he sold his portfolio. Then he called me up, I don't know, 6 months later. He says, man, I didn't realize the taxes I would have to pay for liquidating my portfolio, because he'd been there for quite a while and had all these unrealized gains built into the portfolio. And of course, down here, if you die, then you get a step up, and then you never pay tax on those gains.
Yeah, we don't have the step up in Canada. We don't have short-term gains either.
Oh, you don't? Yeah.
So
yeah, the tax laws are going to vary. They even vary by state, down here. And so that's why we're also, we hired a CPA. We're actually doing tax advice and tax returns for clients now. And I have to say, I don't know why I waited so long to do that. I think it is a huge advantage for the client. I always try to do what's best for the client, because if the client's happy, we're going to be happy. But we've seen such synergy between having an in-house CPA and bookkeepers. We're actually doing bookkeeping for a lot of clients. And I learned about that at a DFA conference. And that has been a wonderful addition as part of our service that we offer to clients.
Yeah, that is great. We aren't doing the tax return filing, but we do have a CPA on our team, and even just to have a CPA that can talk to the person doing the tax return is huge.
Huge. Yep.
You talked earlier about the one of the definitions of an active investor is not understanding or acknowledging risk. When you explain risk to your clients, how do you define it? I mean, risk is such a broad term. How do you think people should think about it?
Well, I'm kind of old school there. I really like to think of risk as the uncertainty of your expected return. Let me go back to one more chart. Sorry to keep going to all these charts, but this is what I've been doing for 21 years. Usually I have people on the other end of the line. We weren't even doing screen sharing half the time, more than half the time, because we couldn't get the clients to do it. And so we tried to make our site easy enough where we just tell them, go to chart number 6, on the charts page, and they can do that. But I always like to think of standard deviation more simply as the uncertainty of your return. When you've got this high standard deviation investment going back to the bell curve, it's just a reminder that there's a very wide range of possible outcomes. And it's even less likely for you to get this average or median return. And so anyway, that's the main way. I know the main way I like to talk about it. I've read, the 20 other definitions of risk that talk about running out of money and, all those other issues. And certainly those are also very important. But, we were doing evidence-based investing before the term was out there, that I'd heard anyway. To me, it's all about showing people evidence and data and information. And the more interactive, the more clear we can make that to them, the better I think they understand it. And so we call this the big chart here at IFA because it's kind of the whole story. And I always remind people that, a 20-year-old sat at the University of Chicago Library in 1951 or 52, and all of a sudden it hit him that the uncertainty or the volatility of your return should be just as important as your returns in the historical basis. And that's why it's really important that you consider this chart. And there's just this pretty, straight line relationship here between that uncertainty and the return. If we turn off and if we just look at the portfolios and not all these individual indexes, there's almost a 1-for-1 relationship. Here we see it at a portfolio 60-40. The return's 9.58. This is 50 years. And the standard deviation is 9.9, So a unit of uncertainty is a unit of return. And you can, I think, make this relatively easy and simple for people to understand, even though they don't have a lot of background in financial science.
And Mark, you were one of the earliest adopters of the internet to explain these kinds of concepts on the internet to people. And I know I was an avid consumer of this, especially when, back in the late 90s, we were migrating towards, structured evidence-based type portfolios. Really curious to hear from you what you've learned through developing like a little mountain of information that you've curated on your website. What have you learned by developing this content, both from just in general, but like what have you learned about communicating this message? What resonates with people? How have you changed through this over time?
I think the first thing that comes to mind is how difficult and expensive it is to maintain this information. I remember I had one of my advisors who left, and then he set up a website. I said, oh, darn, he's doing the same thing I'm doing, no? But he never updated. He did it one time. Like 10 years later, he had the same 10-year-old data. The maintenance of this is incredibly difficult and complex. Also, to have the data consistent across all these charts, I got 90 charts on this page, and to have it be consistent across all this information, both in a color and a design, a color palette, a design, a chart formatting with the title, the subtitle, the font sizes. There's just so much that goes into creating charts that illustrate, your ideas in an effective way. That it's really, I think, difficult to appreciate how hard it is until you actually do it. The other thing that occurred to me is we did podcasts. I think I did 100 podcasts with a couple other guys from another firm. And it was just so difficult to try to explain some of these things without showing some of my charts, as I'm doing with you today. I know you said you hadn't done that before. Well, I hope that it's useful for people to actually see some of the data. But what happened is in the podcast, because I couldn't show the chart, I found that it was so difficult to talk about them and try to transmit that information that we then transitioned to a video type of formatting. And we built an in-house studio. I think we were maybe the third, at least DFA firm that I'm aware of, that built an in-house studio so that we could start producing our own videos in-house. And that's where I think it really started to blossom, and really the educational impact really started to break through with prospectives, clients, even other advisors. I mean, DFA likes to say I probably brought more advisors to DFA than DFA did, because they see this information on my site. But the transition into video, I think, was really important. Then the last thing I recently learned is that the data you have up in any advertisement, which my website is, cannot be stale. This is the SEC's term. And so about a year ago, we actually took down 80% of the articles, charts, and videos that we had on our website. 80%. I went home and had a funeral for all of my data and articles that I had been collecting and creating in over 21 years, which was really valuable. After we took it down, I had so many of my advisors, calling up, where's that chart? Where's that article? Sorry, we had to take it down. So we're now in a process of taking that 80% of the website that we took down and updating and refreshing and republishing that information.
What a big project, but it's effectively a public service. Like the information is so valuable for people.
Well, it helps me with my mission. You might have seen my mission. It was just to help change the way the world invests. Of course, the World Wide Web helps me in that respect. But I hear a lot from a lot of international investors that use my website to educate their clients all over the world, as you were one of them, I guess.
We certainly are.
But
all right,
it's been a pleasure. It really has been a joy for me to share this information. And I'm more than happy to help all these people, whether they became a client or not. Go ahead.
Yeah, exactly. We feel exactly the same. Our world, being the world of wealth management, if you want to call it that, is very focused on investing, probably more so from the consumer's point of view. I think people think we manage investments and that's it. And our conversation in this podcast has met that standard, I guess. We've mostly talked about investing. But as you know, and as we know, that's really a tiny part of, or a relatively small part of what we do when we're actually spending time with clients. Can you talk a little bit about the other aspects of managing money that people need to focus on?
Well, the first order problem in investing is saving the money to invest, right? And so I think, that's a key issue. But many of us advisors, we're already working with people who have already saved enough money to have enough assets to become our clients. It's probably why we spend more time on the investing side. We also do 401k plans. I think we have 55 401k plans. And in that division of our company, we spend a lot more time teaching, plan participants, company employees who have literally no knowledge of investing. A lot of that focus is on getting them to save, because they don't know an active from a passive fund even. And so certainly savings is a huge thing. The other major issue, which I heard you speak about in previous YouTube videos and podcasts probably, is the whole withdrawal rate issue, safe withdrawal rate. How much can a client take from their portfolio in their retirement and be in a position to not run out of money before they pass away? Huge issue. And then of course there's the whole spending side. I have a lot of my clients. By the way, I still manage almost a quarter of our $3.7 billion of clients. I'm personally involved in managing those clients. I work with an associate of mine, but I'm still doing daily client meetings with clients now, doing over Zoom. But the spending is also a huge issue, and a lot of clients come to me and say, is it okay if I buy this, or okay if I go on this trip, or whatever, spend this money on my kids? And so those are a few of the issues. I think the other thing that comes to mind is that they look holistically, at their whole, balance sheet, really. We've been using eMoney for quite a while now, and you can aggregate, the logins to all their various financial related accounts and pull on all that information. Although that's becoming more and more difficult because of the security required by banks and brokerage firms. And so it's harder and harder to do this account aggregation. But those are a few of the areas, all of which I think are important. I would like to say that, financial planning is a very difficult topic, and a very difficult result that you end up with in this process in terms of interpreting it. I really think the real value of financial planning is the process of doing it, making the client more aware of all of these elements that I just talked about, collecting that information for them, and then giving them this snapshot in time. But that's all it is, because things are going to change for them. And they're involved in a random walk through life, like the market is a random walk. and there's going to be changes in their situation on an ongoing basis. And so these things have to be revisited, and it just gives you a nice format to go back and update all of these aspects with the client on some routine basis.
You mentioned a couple of times during our conversation the value of having financial advice. Now, acknowledging that we all may have a bias, we agree. We think advice is valuable for a lot of people. A lot of our podcast audience, I don't know exactly how much, but a portion of it is DIY investors who are listening to try and educate themselves to make better decisions and to manage their own money and obviously save on costs. What do you think it takes for someone to successfully manage their wealth as a true DIY investor?
They basically need to become an advisor. It reminds me of that lawyer joke. An investor who represents themselves in the world of the capital markets has a fool for a client. That's like the lawyer represents themselves in court as a fool for a client. There is a lot to this, and it is evolving constantly. I mean, the whole profitability factor, for example, okay? How is someone supposed to be able to keep up with that? I just had 3 separate conferences with DFA working on ways to try to explain the profitability factor, to prospects and clients. This stuff is really very complex. To be able to look at this data, to update this data, to even be able to calculate what returns you earned in your do-it-yourself portfolio. Come on, give me a break. I haven't seen a client in 21 years who have brought in a proper performance report on their returns. And I see a lot of do-it-yourself investors. Basically, they're coming to my website. They're as part of their research. Yep. And then they kind of get to a point where maybe I'll just talk to somebody there. I'll get a little more information that I can, do on my own. But the real issue is we don't have a record of what these people have done. So how can we conclude that they have done a good job at it? The evidence is so overwhelming that individuals, all their behavioral biases, their lack of information, so much, I think. Listen, in my own experience, I went all that time, 12, 13 years, and here I'm a CEO, I'm a relatively, educated person. I remember somebody telling me one time, you should really hire this advisor to help you. I said, oh, no, I'll be fine. I got the stockbroker, And I'm sure that comment probably cost me a ton of money, and maybe not all of that money I discussed otherwise, because this guy was probably active. 98% of advisors are still active, I think. So I just think it would behoove everybody. There are some lower costs, even if they did a robo solution. I think it helps them, but because the robo doesn't have somebody to talk to, although they're starting to add that because they've realized how difficult it is, you just need someone to represent you in these capital markets, because it is very complex. It is brutal. It is so difficult. You have to have nerves of steel. It's so hard on the mind. To stick with small value in what we see here, it's almost, I don't say it's impossible, but it's very difficult for someone to do that on their own. We have other advisors to talk to. Who are they going to talk to? They're going to go to some discussion board where somebody's talking about, their Tesla hit or something, or go to Robinhood. Oh my God, this Robinhood, huh? We're right back to day traders all over again. And now they get to do it supposedly for free, but nothing's for free. I'm sure they got some charges they're putting in there, although I've never downloaded that app. But I am involved in Acorns. I don't know if you're familiar with Acorns.
I'm aware of it, yeah.
Yeah. So I'm on their finance committee there. In fact, the founder of that got the idea from being my client.
Okay, cool.
Yeah. And he brought his son in. His son didn't have any $100,000 to invest. That's our minimum. The son says, well, what are me and my friends supposed to do, So that's how they came up with this idea of this very successful app.
Very interesting. So our last question for you, Mark.
Yeah.
I mean, you've had an incredible career from early financial success to creating this breakthrough utilization of technology and building a great business around it, and just giving so much to the advisor community, to the investor community through the years, and your clients, of course. I'm curious how you define success in your life, and not necessarily business, but that's what we're most familiar with from our conversation. But how do you define success?
Man, there's a lot of books written on that. That's a tough one. I think the first thing that comes to my mind is freedom of choice. Okay, I just have a little more freedom to choose what I want to do, when I want to do it, when I want to do it. The other thing that occurs to me is I get to choose who I want to work with. This is really important. I think Michael Kitces was talking about the fact that some people, slave away in a job they don't like, to save enough money up, right?
Yep.
I don't have to make those kind of choices. But I think probably even more than all of that is I get the opportunity really to help other people through, my charity work with our hospital, and even through my website. In many ways, they jokingly call me St. Mark at the office because I put all this stuff out for free for everybody to have access to. And I really get some satisfaction on being able to help so many people. And even when I talk to advisors like you guys, I like to think that I've helped your clients, okay? And that helps their children and their children down the way. And actually, I like to compliment Dimensional on this, about how many lives they've touched. You think about on a global scale what they've done through educating all of us advisors and all their institutional clients they've helped as well. And I think that I maybe just did my little piece there. But and then that help also goes to my family and my kids and friends that I've been able to help. And so those, I think, are all elements of success. But the success is a tough concept. Those of us who work probably a little too hard probably never think we get there. When do you ever reach that level of success? It's like when you get to a certain level, then you see something else that you want. Yeah. And it feels like we're always on a little bit of a treadmill. I often say I should probably write a 12-step recovery program for my work habits. But we're all, you're probably in the same boat, a little bit of workaholics. But I think it's required to really make a difference in this world. You basically have to outwork the others or outsmart them, or some combination of the two, to really make a mark.
Well, congratulations on making a mark in this industry and on a great career. And certainly you've had an impact today with our listeners. So Mark, it's been a great pile of fun having you on. So thanks very much for joining us.
And congratulations to you guys. Yeah, you're doing a great service to all your listeners and viewers. And it's certainly one that resonates with me. And I really think you guys are doing a wonderful job. So keep up the good work.
I got to ask real quick. I know we kind of just ended the conversation, but I'm sure some of our listeners are curious, because I am. So you had this public company when you were 32 years old, then had an exit and a liquidity event. What was the company? Like that in itself is crazy. What was the company? What kind of company?
You're going to be a little surprised. The company was called Syncor, and we were a distributor of radioactive pharmaceuticals. We put together what were called nuclear pharmacies, where we mixed up radiopharmaceuticals and distributed those to hospitals and clinics within 2 to 3 hours of our pharmacies. And we did that in 45 cities all over the United States, and eventually expanded to Canada, Mexico, Taiwan, and other countries around the world. And 2 or 3 years before we sold out, the French government caught wind of what they were doing, and they wanted to distribute some of their radioactive products in the U.S. They called us up, sent a French investment banker over. They ended up buying a third of the company. And that's where I got my chunk of money. Because when they bought in, I sold some shares and there was cash there. So when we sold the company, I got some of that cash. But that was a difficult process. That didn't work out very well. Their products were not competitive. And we ended up having to, break that whole thing up. So anyway, I'm a nuclear pharmacist by my first education.
Wow.
And I learned a lot about statistics. In fact, one of the things, in nuclear pharmacy, there's a journal of nuclear medicine. And one of the things that shocked me when I first started digging into all this is there were journals of finance. I always thought there was just, magazines and Wall Street Journal. I had no clue a journal existed with peer-reviewed academic data. And I have to say, my experience in medicine really brought the importance of that to me. And I'm sure, Bill Bernstein probably had the same epiphany when he saw these financial journals and why he was, able to pull onto that. By the way, he was a big influence on me in the early days. He's got an incredible talent for humor in his writing, I would add, let alone the high quality of the way he explained the data. But even that was difficult for many people to, dredge through and really appreciate what he was saying. I think it was a very slim percentage of the investor community, individual investor community, who really understood that. And
he acknowledged that too.
Even Bert Malkiel's Random Walk. I can count on my two hands probably the clients. We have 2,350 clients or something. Maybe 10 of them that I know of that walked into my office and said, "Oh, I read Random Walk Down Wall Street." And another classic, for your listeners, if you hadn't read it, you really need to read that. Little Book of Common Sense Investing is another real classic. So,
awesome. All right. Well, thank you for the story and thanks for being a guest today. It was a great conversation.
My pleasure. Talk to you later.
All right.